Good evening and welcome. So Mercia is a listed hybrid investment business, and I'll take you through the investment model that we operate in a moment. We manage third-party funds where we first source and nurture and scale and grow young businesses predominantly, and then we selectively bring some of those companies from the funds portfolio onto the balance sheet, and we use our own balance sheet resource to then really scale those businesses, and I'll give you examples from both of those fronts in a moment. We're listed on AIM. Our ticker is MERC, Merc. Also, what I should say is if you go to the website merciatech.co.uk, there's a white box on the front there, the left one. If you click on that, we have a Capital Markets Day on the 18th of October, and I welcome you all to that. We are deliberately opening that up to make sure that retail can see exactly what we're doing there, and that has the full board, our investment team and portfolio companies there. So, as I said, if you go to our website and click on a box, you'll get directed and you'll be provided with agenda and timing, etc. And it's in London. That event is being held. Plug over. So Mercia is one of, well, there was a Bohurst report actually. So Bohurst just recently put a report out about 2 or 3 weeks ago showing the leading venture capitalists, the leading venture capital providers in the UK, and Mercia was put as one of the 4. So very quickly we've come to being up there with the top venture capital providers. However, there are not many top consistent performing venture capital providers, and that's because venture capital as an asset class, and we sort of sit alongside the index and Boulderton, that was within that top 4, is really, really tough. You get it right and the returns are tremendous. You can get far superior returns, but it's a tough asset class to crack, and this gives you a little bit about the sort of environment that we, Mercia and other venture capitalists operate in, and why we think our model, which is already delivering, is fit for purpose for this community. So what we have is 5.6 million small to medium-sized enterprises, SMEs, within the UK. So 5.6 million businesses in the UK. However, only 4% of those will ever go on to a turnover of £1 million. So only 4% of that community will get to 1 million. And only 0.4% of those will get to a turnover of 10 million. And what the VCs are looking for is what these 22,000 businesses, these scale-up businesses that are across the UK, but they're trying to look at it from that perspective. So how do you identify it from that and get it down to that? So that needle in a haystack phenomenon is a real challenge. And what we're also then looking at is not just those ones that can get to 10 million turnover, but can continue to grow thereafter. So you're looking at that scale-up provision. So that's the first thing to be cognizant of. The second thing over here is just the time frame that's involved here. So over time, and this just stacks up over time, is that the median time from your first initial seed investment, and I'm sure a number of you have invested in young businesses, but from the first initial seed investment through to a cash realization. So we don't class an IPO per se as a realization. Unwinding from an IPO, that's a cash realization. So that's what we're meaning here. So from first investment to a cash realization, on average is about 13 years. Medium. So it's a long journey, and most VC funds are 10-year funds. So again, there's a challenge there. How do you do early stage investment in that time frame and phenomenon? To IPO, it's about 10 years. And what's interesting in the US, it's between 13 and 14 years. So we tend to IPO in the UK businesses more quicker than our overseas colleagues who tend to hold on to them. So it's a long journey as well. The next thing here is to do with universities. We have 19 university partners, and about 25% of our deal flow is from our university partners. Often they talk about the triangle of Oxford, Cambridge and London. However, we operate in the regions, so you'll see more and more as we go through this presentation that we occupy offices and our funds under management through the Midlands, north of England and Scotland. That's where our 19 university partners are as well. You add up those regional universities and their research income way exceeds that of that triangle. Yet there are very few that are taking deals from that. So we very often are the only one looking at opportunities there. So that's great for us, not so good actually for the regional universities, I would argue. The other point here, as we find ourselves in London as well today, is that over 60% of the venture capital that's deployed in the UK is deployed in London and out of London, in the sort of greater London region, so within the M25, if you like. So in other words, 40% of it is going out to the regions. But what I think is quite interesting is then you come over to this point here, so back to that 22,000 scale-ups, over 70% of those scale-ups are in the UK regions. So that captures our model. It's about patience, it's about how do you funnel them through and how do you take advantage of a lack of capital in the regions. And that's really at the heart of what Mercia is, this slide here. So very proud of our share register, actually. We've got NFU Mutual, we've got West Yorkshire Pension Fund, we've got Bailey Gifford, we have Invesco Perpetual. So we have some very long-term pension funds within our share register, quite a diversified base in that regard. But a question is, why? Why do we have this sort of share register that we're made up from? And these really are the bullet points as to why. The first thing is we've got something like 85, 86 employees now within Mercia across 9 offices across the Midlands, the North and Scotland. We see pretty much everything in the regions. We get that access to those disruptive tech businesses in the regions that others just don't access. I've mentioned the 19 university partners where we work with on a non-exclusive basis and access the deal flow that's fit for what we're doing in those regions. With that level of headcount, what we provide is the resource that those young businesses lack. These young businesses are not just short on capital, they're short on sector expertise, they're short on certain disciplines that within a startup business are required if they scale quickly. We can provide that, and we do provide that. We ourselves are a very capital efficient business. So I'll talk about the funds under management, but we have 400 million in funds under management within our fund management element of Mercia. That is a very profitable fund management operation which generates cash across the group. And Martin, Mercia's Chief Financial Officer, will talk about trading progress in a moment. And you can see how that covers a majority of our operating costs from our previous results published in March 2018. We have a track record as well, so it's great about being enthusiastic in front of you, but we have a track record of delivering from our funds and our balance sheet, and again, I'll touch on that. The risk mitigation is really important because the nature of our funds is they are government-backed funds, they are EIS funds, they are funds that are constructed to account for the risk behaviour of early-stage investments, whereas the balance sheet, the PLC balance sheet, does not have that liberty of tax release, does not have that government backing, etc. in it. And so what we're looking at here is removing as much risk as we can within the funds portfolio before we bring them onto the balance sheet. And we've got about 20 assets on the balance sheet which have been through that de-risking event. And then the final thing is co-investment, which was not something when Martin and I brought this business to the market back in December 2014, was not something we originally envisaged, which is the institutional investors that are on our share register do not have the resources to access these businesses, but do have the capital and the desire to get into them. So we find actually on our balance sheet investments is that there is an opportunity and an appetite to co-invest, which is a sort of Series A-B on our balance sheet to come alongside us. So this is an important slide in terms of, some of you I know are shareholders and I've met you, so thank you for joining us on this journey. But what is it that you get when you acquire a share within Mercia? So I always wander around. So if you look at the makeup of a share as a sort of simple pie chart, so almost 45% of it is those direct investments, and we'll talk through those. And if you come to the Capital Markets Day, almost all of those will be there as well for you to talk to the senior management teams and see the products they have. So that's almost half, 45% of it. The other thing is just hard cash. We've now got about 40 million. So if you like, this pie chart has swung across because we've been putting cash into these and new investments over here. But that adds up to what we sort of call, that's your NAV makeup per share. Your net asset value makeup per share is your direct investments and your cash. And if you put that on a NAV per share, you're up to a sort of 40.7 pence basis. The fund management business, though, is a very profitable fund management business within the group. If you look at listed comparators and do a turnover multiple or a profit multiple in those, you'll come to a sort of 27 to 35 million valuation for that business. And so we would argue that there's also a 9 pence per share if you do it through that metric on that value. So if you add that in, you've got an additional 9 pence per share. And today we are, I think 34, 35p a share. So that sort of brings you over to what sort of investors have been joining us or are engaged with Martin and I at the moment about joining us. And you split that really into 2 groups of investors. The first one, which we're finding is typically retail, where it's frankly a no-brainer. You can look at the net assets and see it's 123 million. You can look at what the share, and there's just there is a value inflection. There is a disconnect, if you like, between the net asset value and the NAV per share. So there's a sort of value investor. And then what we're seeing here, and this is more to do with the institutions, is that they can see the quality of the assets here, and we've announced in 3 RNSs actually about multi-million pound contracts won by 3 of those businesses there. You can see the progress of the direct investments as well. And so there's a sort of momentum investor that's coming in for the long term in the business. There's 2 slides here just to show progress at Mercia. So as I said, we floated in December 2014. We were a small fund management business. So we were turning over about £700,000. This is, 3.5 years ago now. We had 30-ish assets under management, 30 million, 1 office, quite a clear objective to dominate, to be the leading investor in the Midlands, North and Scotland, and we had 8 employees and 9 university partners. And then I sort of flipped that through 3 years later, so to March 2018 at our results, we've gone from 700,000 to 10.2 million turnover, from 30 million assets under management now to just over that, so just over £500 million now, 500 million assets under management. This is a really pleasing statement as well, 3 balance sheet cash exits. So when we floated the business, we said it would take 3 to 7 years before we would expect the balance sheet to start making cash realisations. And actually, we've made 1 a year since we listed. So that's a really positive step. 9 offices now across the Midlands, North of England and Scotland. 80 employees, this is out of date, so 86 employees now. 19 university partners and 4 more under discussion at the moment. And we have, I shan't go through the board, but plugging the CMD again. The board will be at the CMD, almost all of the board, bar one of the non-execs who can't make it. But what we've got is a board that is built and reflects the environment, the entrepreneurial environment we operate in, but also the highly regulated environment we operate in. And I'd say finally, the ambition that the executive team have for this business going forwards as well. So the board at the top. At the bottom, we have split Mercia really into individuals who source investments, pure-blood venture capitalists, if you like. And then on our balance sheet, this is about scale-up. So there's the scale-up challenge here is how do you take a business that's just about to go into turnover and turnover growth with one team, and how do you scale that into a business that's going to do 200% growth on revenue? And I'll talk about some of those businesses. So these people here, and I'm sure they'll let me say this, have absolutely no venture capital discipline at all. But I'll go through them in a moment, and their experience on running very large businesses in the sectors we back is tremendous. And so the team that sits on our balance sheet is very different to the team that sits within our funds and transacts on our funds. So the investment model, and I think this is important, I've already alluded to elements of this, but we had, up to March 2018, so the 12-month period to March 2018, we had just over 2,000 business plans. And so our 19 universities sit there as well, okay? And we invested in 5.6% of those inquiries came onto the funds. And so within these funds, we've got about 170, 190 venture businesses that are at various stages of growth and development within these funds here. And then it could be 6 months, it could be 6 to 7 years. We then selectively bring businesses across to scale up from our balance sheet. So 2,000, 5.6%, and then we did in that period 3. So there's a 0.2% chance of a business here ending up here. And that's why we think this model works, is that you've got this differentiated and aligned capital, but a selective basis for the balance sheet, the PLC capital to work. Within the funds, we typically take a 10 to 30% equity stake. And then in addition, the balance sheet looks to take a 20 to 40% equity stake. We have 400 million in funds under management and approximately 230 million fresh cash to invest over the next 5 years. So this is a very well-financed part of the business. And on the balance sheet, we've got, it's now about 40 million of scale-up capital to selectively bring those businesses across. These are the 3 full cash exits that we've had. So Abzena was a listed business that we unwound some time ago now from it. These were private businesses on a cash sale. And I think the other point here is to do with pace, actually, pace of growth at Mercia. 2 years ago, that triangle, if you like, that group invested 20 million. Last year, it was 46, and this year we expect that to exceed 60 million. So that's a very active venture capitalist now in the UK as an investment provider. And then, track record. So back to track record. Alinea, we sold that back in 2016, December, so nearly a couple of years ago now, to Arm. In fact, it was Arm's first acquisition after they were bought by SoftBank. The funds, just to show that this is about the funds and the balance sheet performing, the funds made 26 times their original investment cost. The balance sheet made 21 times. You'd expect that because the balance sheet's coming in later. So that delivered a full cash return. Science Warehouse we sold earlier this year to a private equity-backed business. And we're seeing a change. We often get business plans, I'm sure you do, where it says it will go to a trade sale or an IPO. We're finding secondaries through private equity now is a third exit play within the arena. And that's Science Warehouse when that worked. And then finally, Blue Prism, which some of you may be familiar with. We were the founding seed investor in Blue Prism. It's important to note, Midlands business, North of England business, Liverpool back business. We backed this with 2-3 people with an idea. We floated that a few years ago now at 48 million market cap. It's 1.5 billion there or thereabouts now. 900,000 invested, and actually this is wrong now, isn't it? So this is, I think we've taken 80 million now out of that. So we will make about 100 times, so 26 to 100 times returns across that. So this is delivering. The funds that these are in have done very, very well, and we expect the balance sheet to start catching up. And the balance sheet across here, this is the growth in value on the balance sheet, but we're young. The balance sheet is 3 years old, 3.5 years old. So this will catch up our expectations with the fund's historic performance. Back to the balance sheet. So the balance sheet's focus are 4 discrete technology sectors. And what we're doing is becoming category leaders, we would argue, in those 4 sectors. And these 4 sectors have subsectors that are directed by our direct investment team, and they reflect where they see changing trends. Because what we're trying to do, this guides the fund's activity. We're trying to pick what the next winning thing's coming through. So, for instance, on digital, we've got virtual reality, and we'll talk about one of those businesses, but this isn't about developing the headsets. There are people like Facebook and Microsoft and Google putting a lot of money into that. What those headset needs are content. So what we've spotted here is that we've got to invest in a content provider, because when they come to the market, where's the content coming from? So it's about spotting trends and being confident in that respect. And then it's also about making sure that the balance sheet has a balanced perspective as well. So we've got representations from those 4 sectors almost equally across in that regard. These are our 19 university partners. As I said, supply circa 25% of our deal flow in the regions that we operate in. So we only invest from regional universities. And then I've got just 4 short slides before I hand over the clicker to Martin. But these are individual things on sectors, and there's just not enough time to work through each company, but I will be here later on, and so will Martin, so we can take questions on that. But as I said before, we look to build 20 to 40% equity stakes, and you can see that we've done that, and with Vox Pop Me, there's a journey ongoing in that regard. And if I talk to Vox Pop Me, because that was one of the 3 that we did last year, this business is growing well in advance of 100% revenue per annum. In a year, we shifted that. There was questions about Brexit, and we're very focused on our portfolio, making sure that's globally relevant. 70% now of their revenue comes from the US. And that's a business that's working in, so basically it has crowdsourced customers, it has a very clever analytics, AI, software approach, and it just enables customers like Visa, like Tesco's, etc., to ask questions that are not necessarily asked from the audience. So those crowdsourced bases are tagged, they're meta-tagged questioning on that. Very, very impressive business, growing very, very quickly, managed by Alistair. So Alistair oversees this sector, and he's been an exceptionally successful CTO and CEO in a number of software-backed businesses. And also what I should say is none of these are university spin-outs. So software is typically not associated with university businesses. And digital entertainment is typically not associated with universities, and none of these are university spin-outs either. And this is headed up by Mike Hayes, and people like me who've played Sega in the past will recognise the name. So Mike used to run Sega in Europe and in the US. And again, I mentioned the equity stakes. You can see again, we're building big, meaningful stakes in these businesses. Endreams, that's our VR business, and that's the business that's working with, it's got its partners on its own website, but it's working with the likes of Facebook, Oculus, Google, Microsoft, Samsung, Sony. I mean, it's working with them all. So it's working with all of the hardware developers providing content for those, because that's what they need now. They need content now that the technology is working. Whereas these are all university. So all of these have university intellectual property in. So this is what we call ME, so electronics, manufacturing, materials and engineering, all university-derived intellectual property. Again, you can see the big equity stakes that we're building up in these. Sort of look out and try and figure out how many of you drive an Aston Martin DB11. So if you happen to be driving an Aston Martin DB11, you've got parts that have been pressed by Impression Technologies. So Impression Technologies has a technology HFQ, which can press very complex aluminium, large aluminium shaping. So it's obviously very important for lightweighting, important for strength. And so, as I said, the DB11, DB12 to come have got certain parts that Impression Tech press out. And that's based in Coventry. It's got a huge pressing plant based in Coventry, working with Jaguar Land Rover as well. So very impressive business and growing. Again, like our other businesses, growing very quickly. That's headed up by Mark, who's got a huge amount of experience in this sector. My favourite sector, because I am a molecular biologist by background, so I like life sciences tremendously. So this is headed up by Peter, again, has a huge track record of growing and selling his own businesses within the medtech sector. Again, you can see those equity stakes that we're building. All but one of these is a university-associated business as well, university technology. I'll talk to this because I always have a personal agenda, and I like to say this because I like to talk about large and small molecules, which Martin has heard me say 100 times already. But Oxford Genetics, so back to that, how do we spot areas that are coming through? So there's large molecules and small molecules. You take an ibuprofen, it's a small molecule, yeah? So it's a drug. A large molecule is a biologic. Okay, so people may have heard about Greg Winter today getting his Nobel Prize. He came up with a monoclonal antibody. That's a large molecule, okay? I'm a type 1 diabetic. I take insulin. Insulin is a large molecule. Insulin was the first large molecule to come onto the market in 1982. So today, 20% of all therapeutics are large molecules. By 2021-22, 50% will be large molecules. That's a huge pace of growth. And the challenge at the moment for the industry is a cost of goods phenomenon. How do you make these things at scale at a price that's comparable to small molecules? And that is synthetic biology. Some of you will have heard of CRISPR technology, for instance, that's embedded in synthetic biology. Oxford Genetics is one of the leading players in that field. And its turnover growth is tremendous, over 100% per annum at the moment. And that's an exceptional business growing in that space, playing to that strong market pool. The numbers, Martin.
Good evening, everyone. I'm Martin Glanfield. I'm Mercia's CFO, and I'd just like to take a couple of minutes to bring some colour to our March 2018 results, which are summarised here. Although, as Mark explained, we are a balance sheet business model, the growth in the value of Mercia's shares will be directly correlated to the growth in our balance sheet over time. However, as Mark's also said, what we're very keen to do is to minimise the leakage from our balance sheet from the cash that we're spending on our investing activities. And so if you compare the 2017 numbers with the 2018, we have a line that you won't see in too many of our comparators' income statements called net expenses. We like to focus on that line because we're driven to minimise the cash that we're spending overall that's not investing in these young tech businesses. And as you can see, we've made some good progress in the last 12 months in reducing that number. That's partly driven by, largely driven by the increase in the revenue of circa 50%. And that is where our fund management business comes into play. Not only does it provide us with our deal flow of young, interesting tech businesses, but the fund management fees and the director monitoring fees that we can charge those companies, and for managing those funds, that's what helps us offset our cost base, which is largely venture capital investment expertise. As Mark said, we've had three cash exits since we came to the market, and that line there, the realised gains for those 2 years, reflects essentially the cash profit we've made in each of those years on those disposals. And the way that our model works is that we value at each year end and at each half year end, we fair value the investment portfolio that we have on our balance sheet. And the difference between the opening value and the amount that we've invested during the period and what we feel is the value, and I'll talk about the valuation methodology in the moment, which is very prudent from Mercia's perspective, and the difference between how we feel that business is worth at the end of that period and where we started is what's called the fair value movement in the investments. And as you can see, in the year to March, we also made good progress in terms of portfolio value enhancement. 2 years ago, we bought a business called Enterprise Ventures, and as part of that purchase price, we had a deferred contingent element, and the contingent element was largely linked to Enterprise Ventures achieving the winning of new fund mandates totalling at least £80 million over that 2-year period post-acquisition. And I'm pleased to say that they actually achieved over 200 million in new fund mandates during that 2-year period. So again, one of the things that we're developing at Mercia is not just the ability to hopefully pick winners in terms of investing in young businesses, but when we do decide to make an acquisition, we feel that we've got the capabilities, the experience and the skills to identify, negotiate, diligence, integrate and make a success of anything that we decide to buy. So the businesses from a bottom line perspective, from an earnings per share perspective, is progressing well. Although for us, as Mark also has said, we're not really an earnings per share business, we're more of a net asset per share business, as Mark said. Ours was 40.7 pence for the year to March. In our balance sheet, as Mark's shown from that pie chart, there are really only two important numbers. One is the value of the portfolio at 66 million, which I'll show you the breakdown of that in a moment. And then at the end of the year, the 50 million or so that we had yet to invest. So this was our portfolio. This is the makeup of our largest 20 investments out of 26 in total at the end of March, representing here 99% of the total value of the portfolio. And Mark's referred already in that, going through those 4 slides of our 4 sectors, you can see the names of those companies there. So our largest investment by value is nDreams, a very exciting virtual reality business that you'll have seen recently. We've RNS'd that it's won the largest contract so far in its young history. The next one, Oxford Genetics, again, you'll have seen that we've recently RNS'd that has also won recently the largest contract in its history, and so on and so on. And then the third one we've recently announced is Aston iTech down here, also has just won the largest commercial contract in its history. So these are not just businesses where we're putting money into them and hopefully one day they might actually gain some commercial traction. These are businesses gaining commercial traction. These are businesses with blue chip customers already. So we started the year with 52 million. We invested gross 21 million during the year. This year we would expect that to be probably somewhere around 27 million. So again, as Mark's explained, the momentum in the portfolio is growing. We sold Science Warehouse in the year, and that was the value of the business. The 9.9 million there at the bottom was the carrying value that we sold it at. And as I said, we sold that at, I think it was 10.6 million. And then we have a small number of investments at the bottom and some very small capital contributions that we make to some of the funds that we manage. These are particularly the Northern Powerhouse investment funds where 12 months or so ago we won a 100 million mandate from the British Business Bank.
Thank you. So we've been very cunning and used up most of our question time. So just to finish anyway, so the focus of the management team, the executives, the board is NAV growth. You know, this is all about showing that those businesses we've brought across onto the balance sheet can grow. But you have to remember, in the first few years, we're the sole provider of capital. And so our valuation methodology will inevitably be we're holding it at cost because there's no other metric around that. So we're trying to build, but we're three and a bit years through our journey, we expect NAV growth to start to come through. The next thing, as Martin quite rightly alluded to, is cash erosion. You know, if we expect to put £1 in a balance sheet asset and get 5 to 20 back again, every pound we burn in operations is that opportunity cost of that investment. So that's very, very critical to do that. When you have 86 employees, 19 universities, 9 offices, we get to see everything in the regions. And I've talked about those business plans we see. Leveraging those partnerships and that is critical for the investment model. But finally, it's all about realising value. You know, and we have done that for our funds. We are doing that for our balance sheet. And we expect both of those to continue going forwards. Thank you very much for your time.
And just to confirm, as we are a bit over time, you're going to be here for questions, you're going to be around for a drink later on. So if you don't get a chance to ask something now, don't worry, you'll get a chance.
And don't forget the Capital Markets Day.
Don't forget the Capital Markets Day as well. So do you have any questions for Mark, please? Gentleman at the front, got his hands up first.
Thank you for the presentation. I want to find out from yourself, you had 4 areas that you focus upon. And if there's a brilliant idea which does not fall into the 4 brackets, what actually happens?
Yeah. Now that's a very good question and one that we debate internally all the time. So what we do every other year, we have a review of the sectors we operate in. And so our next review is coming up in March. And so don't be surprised if a 5th one comes along for that very reason. So we look at that and we look forwards and we think those 4, and they're quite broad sectors, don't forget, capture what's going on in the strengths of the regions. There's a tremendous amount of investment, R&D investment going into corporates and universities, and there are 1 or 2 things sort of slightly falling outside of that. What we won't do is make an investment in them until we have the expertise internally. Absolutely. So we would, if we recognise that as a sector, we will get that expertise internally and then we'll chase that deal. We're not a generalist investor. We only invest in what we know.
A question, gentleman here, please. Hand up still. A couple forward. We pass it forward on, please. Forward. That's it. Thank you very much. Thank you.
On one of your summary slides, you had Concepta as a featured company, but you didn't talk about it. And it stood out on the slide before last, I think.
Yeah.
So would you like to just fill us in a bit on what the story there is?
Yeah. No, so we were at an Edinburgh event about a month ago, and somebody was good enough to ask us about that too. So a number of things. First thing is, we wouldn't class Concepta as a realisation. It's an IPO. So I think I said that earlier. We only class exits when we've taken the cash out, because it's done. So Concepta, you will also see the results came out and there are changes afoot. So Peter Dines, who heads up our life sciences sector, we have put him in on the board of Concepta. You'll see that there are changes within the management team. You'll see that the CEO has stepped down from the board. So you'll also see that there's a CE mark going past, and we're looking at a UK focus, European focus, and re-evaluating the so that has Mercia, if you like, written all over it.
And a new chairman.
And a new chairman that we've helped put in. So there are things that need to be corrected. We are proactively working with that, and we did inform the city that that's what we're doing at the moment. We still believe in that business. We invested at the last round in that business, and we think that there's a lot there to deliver. We just think that the team needed changing.
And one more question, please. Gentleman behind you. Yes, thank you.
If I've interpreted it correctly, I enjoyed your presentation, by the way. It's fascinating.
Thank you.
The market price of your company is about, I think, 17-18% discount to net asset value. Is that?
About 14.
About that. Do you see that continuing, or is things like your Capital Markets Day going to turn that round? So should we get into the shares before then?
I'm going to let Martin answer this one.
So there's two parts to that answer. I think, first of all, obviously, every share price is driven by more buyers and sellers, and one cannot determine who at any point in time is a buyer and who is a seller of your shares. The second thing is the sentiment in the sector in which we sit. So we sit in, I think what's called specialty finance in financial services of the FTSE. And that is a sector, like as tech in general, which goes in and out of vogue. So when we floated back into 2014, tech was very much in vogue. And at that time, we and our comparators enjoyed a share price premium over NAV of about 30%. Roll the clock 2 or 3 years later, and the sector has suffered one or two shocks. Circassia was referred to earlier on,
Yeah.
which of course was a significant investment of Imperial Innovations, which of course no longer exists because IP Group took it over, and also Allied Mines last year disappointed the market significantly with a sort of a 27% reduction in the value of its portfolio. So what was a sector where investors were happy to believe in the inherent value of a company's portfolio of investments, and give that company a sort of a circa 30% share price premium over NAV, the sector has largely gone to a discount to NAV at the moment. And I think it'll take a while for those of us within it to prove, as we intend to, that there is inherent value in our portfolios sitting on our balance sheet.
Yeah. And it's beholden on companies like us to make sure that individuals like you can access information. So we have an analyst report that will come out on the day of the Capital Markets Day, for instance. So we have to, that's why on the CMD we've got funds portfolio and direct investment portfolio. So you can come and have a look for yourself. You can say, well, look somebody in the eye and talk about the product, and look Ryan in the eye about oxygenetics and find out, do it for yourself. So, and that's what we sort of encourage everybody to come along, because, we think there's an inherent value in the direct investments, and there is such opportunity. We can see what's in the funds, and we look forward to bringing those across.
Yeah.
But that's our opinion.
And it takes time. And let's not, beat about the bush. It takes time for these young businesses to mature, and as you've seen with the recent announcements, they are beginning to.
Yeah. Speaking of time, thank you very much
Thank you.
indeed.